Folks we've already known a few that are going to get off a little early. There'll probably be some people coming on late. But it is my great pleasure to introduce Ingrid Stafford to you all. Ingrid is a graduate of Wittenberg University with a degree in economics and political science and graduate degrees from the University of Michigan and Northwestern, including an MBA. She began on the staff of Northwestern and eventually retired from there in 2019 as its vice president for financial operations and treasury. Ingrid knows finance. Let me just say that right from the get-go. She knows finance. And so sometimes this is a tough subject for us because everybody goes, well, you know, I only have a partial picture and I see my budget. But it's really important for us at whatever level we are within a university or a nonprofit to understand the questions and the issues that exist across the institution in terms of budgets and cash flow and planning and how this all fits together to make our institution a viable institution. And I think many of you know that we had an announcement yesterday within the Concordia system that Concordia University Portland is closing at the end of this term. This is an institution with 5,000 students. They can't get there from here before this summer. So it's an important issue. It's a big issue. It's a technical issue. And there is nobody more qualified to be able to talk to us about this than Ingrid. After she retired, she serves on numerous boards now in the private and in the non-for-profit sectors, where she is used as a financial expert, chairs audit committees for places like Wintrust, Evanston Alternative Opportunities Fund, USA Technologies. So Ingrid, we're just so happy to have you with us. We're blessed by your presence and your expertise, and you have the floor. I'm gonna one qualification. Yesterday, Ingrid and I practiced, and Texas is having a lot of bad weather, and we fell offline. So if I disappear, life is all fine. Ingrid's got this one. So Ingrid, you have the floor.
All right, thank you very much, Tom. And no, this has been a neat opportunity. I met Lauren and Marianne at the celebration dinner for their leadership of the ELCA campaign. And as we were chatting and kind of making connections, I'm looking for kind of new opportunities to serve in retirement. I had been familiar with LECNA a little bit and just said, hey, if there's anything I could do to kind of help as part of this leadership development, which I think is so important for our Lutheran colleges. And they looked at me and said, sure, we've got a session. Do you want to teach a session on finance? So with the help of Tom and Lauren in terms of like background of this particular segment and where it sits in your curriculum, hope that we can kind of accomplish a good high-level overview today. Certainly finance has a lot of different dimensions, you know, depends, you know, there's many. We will hit basically the blocking and tackling today and hopefully leave enough time for questions. But also hope that this fits in with your curriculum. You've already done a session on planning, Tom tells me, and you've got another one coming up on budgeting in a little bit more detail. But I hope that this kind of core of kind of what the key tools are in terms of finance kind of helps give you a grounding for kind of the basics of what you need to know. I'm sure some of you have got some of this background already from your leadership positions, but you know, we'll leave enough time for questions, and if there's any opportunity for follow-up or things that I can be helpful on after the fact, I'm more than available one-on-one. So looking forward to this, and please interrupt if there's questions along the way. So I think, Tom, we'd be ready to put am I going to put that up for my end here? Whoops.
Ingrid, why don't you go ahead and try it from your side, the share screen, and see if it works. And right. If not, then I'll do it from my side.
All right. I see it there.
Okay. And if you look at the bottom, you should see the green box share and then pick a screen.
Oops. See,
I'll tell you what, I'll just do it from my side.
yeah, I think so. I don't see that.
Okay, and then what we can do is you can just tell me when you want to go forward.
Okay.
Everybody should be able to see the slides now.
Oops.
Yep, they got them.
Okay. Very good. So we'll move to the, I can see if I can control it from here. Does that move it, Tom?
No, but I have to stop share for you to be able to do it. So
Okay. All right. You go ahead.
okay, there you go.
Very good. Now I've kind of lost the picture of, I'm just seeing the slides. Okay. So I think the primary focus of kind of how we approach kind of finance really starts with understanding kind of the mission of the organization that we're leading, understanding kind of where the authority for that mission lies, and then we'll move into kind of understanding where planning, reporting, kind of an auditing kind of works in that context. But I think starting with mission becomes important because mission is what, and the organizational construct of a university or a college kind of really helps define sometimes kind of how the financial operations and the budget operations of an organization work. So we'll kind of move. So today what we're going to do is start with mission, talk a little bit about authority and planning, then where financial reporting fits into that picture, and then, you know, work through some auditing kind of key tips and then a summary. So we'll move to the next page about mission. Is that moving forward, Tom?
I just moved it forward.
Okay. Something's not clicking on my.
Yeah, just let me go ahead and move it. Can you see mine?
No, that's what I need to kind of, maybe I need to back out of my, there we go. There we go. Got it now.
Okay.
Now I can see. So we all know that all of you are kind of working in Lutheran colleges currently, and you know that our Lutheran colleges were kind of founded to fulfill unique missions. And that was either through the philosophy of education that they brought from kind of their immigrant roots to America, or the geography in which they landed, the particular form of faith or cultural focus. And that in the articles of incorporation or the bylaws of every organization, of every university, that kind of sets the framework for kind of what the goal and kind of why was this college or university founded. And within that, usually the articles of incorporation or charters define kind of the legal entity that constitutes what is going to be the entity for which we're responsible. The reason I kind of bring this up at the beginning is that we know that some of our church colleges are sometimes separately incorporated as independent entities within their own states. But we also know that sometimes our universities and colleges are part of a synodical structure. They might be part of the ELCA. They might have a relationship both with a synod or with the ELCA itself, or within some other organizational body. And I think the reason I just call that out is that those types of terms and kind of characteristics of how a college and university is formed helps determine whether whether the leadership of that organization needs to be accountable to some other kind of entity. Most of our 28 Lutheran colleges and universities within the ELCA are the vast majority are just typically incorporated under a state charter. And under US federal tax law, they're called a not-for-profit organization. And you've probably heard the phrase 501c3, which gives the ability of those organizations to be exempt from taxes for the vast majority of their activities. And that structure in the federal tax code is what gives permission for organizations that have a social purpose, social cause, or advocacy, and that returns its excess revenue to its mission, and it defines the activities that are exempt from and subject to taxation. And that becomes important in terms of fundraising and other kinds of strategies that help sustain our colleges. So as you start in an organization, it's always good to kind of ground yourself as to whether there's anything new or unique in your institution's mission that would somehow influence or impact your budgeting, your planning, your strategy, and your finances. So we'll move forward. So again, a charter and a bylaws within that organizational structure establish the authority for the fiduciary responsibilities. Many of you probably are aware that the primary fiduciary responsibility rests with the board of directors, and more specific oversight is typically assigned to a finance committee or to a similarly named committee. It might be called budget planning, it might be called, but typically finance. And the duties of a president or a vice president for finance may be generally identified or specifically enumerated in those bylaws and charter. And then that authority kind of dictates how typically the financial work plan that supports institutional strategy and mission. And again, these are just good things if you were in a presidential role or you're in a vice presidential role, understanding whether there's any permissions or limitations set in authority would typically be in this area. Moving to the next.
Quick question back on authority.
Sure.
I've always been interested in the role of the treasurer being independent or reporting to the president. Can you say a little something about that?
Sometimes that occurs in organizations if, you mean as opposed to like the treasurer, that probably, I've been familiar with that in a couple of different contexts. Sometimes that would be, particularly if the treasurer is responsible for long-term investments, that relationship, that's significant enough that sometimes a relationship that could be established to the president. It could be an example of something that could be established in a bylaw or in a charter that might be from an earlier kind of where the board wanted to have kind of the representative of the fiduciary, their fiduciary kind of independent. Typically today in a larger university setting, a treasurer would typically have responsibility for long-term investments, and sometimes in those cases they would report, if it was significant enough, they would report to a president. But in other structures, you could have a title of treasurer and that would just report up to a chief financial officer. Really
okay.
depends.
Ingrid, when I took over my presidency, and Carl, this was a lot of financial stuff, the CFO actually was contracted by the Board of Regents.
Right.
Because the board viewed its relationship, the CFO's relationship to the president in the past, and to the board and truthful reporting, there were conflicts of interest. So
right.
The board wanted the CFO going directly to the board.
Right.
Now, I had a great CFO and we worked well together, but there may be, Ingrid, there may be those times, especially in smaller ones, where that helps the board get the straight scoop.
Right. So when that background of kind of mission and authority, then you move into a planning function. And again, I understand from Tom that you've already been through this, so hopefully this won't be repetitive, but the planning function, a president and the senior cabinet, which are identifying strategies in order to fulfill the mission, they would typically create an institutional plan that kind of defines those priorities. And then the budget, the next would be the financial plan that kind of actually is the basis for how the institutional plan is going to get implemented. And it would probably have two components, an operating component and a capital component. A capital meaning that you're either building physical assets, or it could also mean that you're deciding to kind of expand into kind of new programs. But the cost of entering into new kind of programs might require some unique kind of financing and investment. So the budget, next line, the budget framework will typically, many of our strategic plans are kind of multi-year plans. Sometimes they're associated with capital and fundraising plans. And then, so a budget framework would also typically include a multi-year forecast that should also kind of balance the objectives of that institutional plan. Typically, that framework sits into kind of an annual budgeting cycle. I'm sure all of us are familiar with that. That usually within about 6 months prior to the start of the next fiscal year coming up, you begin to have more intensive discussions about actual operating budgets. And you're also all probably familiar that the iterative process to reach consensus on a balanced outcome. Most all of our organizations require us to have balanced budgets, if at all possible. And so the iterative planning process, those of you who are already in senior roles, you know that you're working through those types of discussions, academic, administrative side, in order to come to a balanced plan. Moving forward. So the operating budget plan should incorporate all the known financial obligations and commitments that we have. And I think one of a common risk factor to look at in our institutional financial planning is that sometimes budget plans don't include everything we know we're going to do. And that sounds kind of basic, but believe me, even in the biggest, most sophisticated organizations, there's always kind of activity going on that might have a financial impact that either does or doesn't get it fully incorporated into the budget plan. But a typical budget plan is going to begin with baseline assumptions about expenses and revenue. Inputs would typically be enrollment, of course. For all of our colleges are very enrollment based. You have non-financial data and financial data coming into the development of a plan. You also incorporate kind of what's working in the current year budget versus what's not. And some organizations kind of take a zero-based approach, which would be, we're going to start from fresh and we're going to kind of build up depending on how serious some of the budgetary issues are. Most of us work in an incremental budget model where you're kind of working from 1 year, you're kind of calibrating what your multi-year forecast needs to be, and you're moving forward into the next year. And it would typically include good budgeting includes a contingency factor to allow for unexpected changes in revenues and expenses, because you can't predict everything that's going to happen. And then it's also important to plan against to measure your performance against actual performance consistently and timely. So that's kind of your planning framework. So again, to kind of move to the next, the capital budgets would also be developed with using the concept of sources and uses. And again, typically capital budgets are kind of derived from your institutional strategic plan. And you're looking at slightly different kinds of sources. Typically you're looking at gifts and philanthropy. You might be looking at grants. You might have a contribution from operating revenues, but you might also be looking to kind of debt finance because you're trying to work for assets that will kind of benefit multiple periods. So typically that might be new construction, it could be renovation, it could be technology, it could be academic programs, like if you needed to build out a new discipline or Tom and I were talking earlier about this situation up in Portland with the Concordia College where they were trying to kind of build out online infrastructure, and that could be an example of a capital budget. There has to be a linkage between capital budgets and operating budgets, and that's typically through two components in a financial plan. One is that if you have used borrowing, if you've borrowed funds in order to help you kind of create capital assets, you need to provide in your operating budget for the payment of interest and principal. And then you have depreciation, which is the accounting measure that we use to kind of measure the using up of physical assets. And in every financial period, you should acknowledge the fact that you used assets during the year and you diminish some of its value through the using up of that asset. And that depreciation factor is it's not cash, and it doesn't cause us to have to pay a bill, but it's still an expense. And I would say, in my experience working at Wittenberg and seeing other Lutheran college, this area, particularly of depreciation, is probably the one area that creates the greatest amount of stress in our Lutheran colleges, because we typically aren't generating kind of either current operating revenue or philanthropy or other sources of revenue that enable us to basically sustain that cost that we're absorbing in our financial statement. And many of our colleges, if we compared across the 28 plus the Concordias, we would, the other Missouri Lutheran affiliated, but all small liberal arts colleges struggle with this. We typically all have older plants. We've all been in business since the between 1850 and maybe 1900. These are now 100-year-old buildings. They need to be renovated, sustained. We have housing, all of these kinds of demands. And most of us can kind of make our budget balance on the basis of current operating revenue and current expense. Being able to cover that depreciation cost is kind of one of the real challenges. So a sound financial plan will have operating revenue, ideally, to fund the operating expense and the costs associated with capital. So a recap before we head into the guts of kind of financial reporting. Best practices: conservatively budget revenue, try not to limit our reliance on one-time sources, budget contingencies, build capacity if we can to meet annual depreciation and debt service. Always be looking at stress testing the assumptions on major revenue and expense items, and consistent reporting of plan versus actual. And we've got some resources listed here. I certainly, just in general in this conversation, I would, recommend as you move into leadership that that two organizations are very strong in this whole arena. NACUBO, which is the National Association of College and University Business Officers, which virtually probably all of your finance colleagues are members of both the regional associations and the National Association. And then the Association of Governing Boards, which kind of takes a viewpoint from trustee level of these issues, and they all have some great resources, and I urge you to keep them on your bookmarks. So after we have our budget set, we move into reporting, and plans and budgets represent expectations. They're about the future. But financial and non-financial reporting represents actuals, kind of what is happening and what has happened. And the piece within our financial realm, there's in addition to financial reporting, of course, we know, and you know this from your from your responsibilities, we report on many other non-financial indicators that are important to report: enrollment, head count, program developments, philanthropy, gift progress. All of those elements are important. And then in addition, we report on kind of actual financial kind of activity, and that's typically done on a monthly cycle with usually quarterly and annual reconciliation to budget reporting. Actually, I think a lot of the Lutheran colleges do, at least I'm familiar with Wittenberg and a handful of others, I think do a generally really good job on monthly cycle reporting, also comparing to budget. And that reporting is typically driven by kind of external reporting standards of what we have to produce in our audits. And for the Lutheran College world, the body that kind of sets those standards is called the Financial Accounting Standards Board, or FASB. And there's been some new activity in that within the past 2 years. There's a number of changes, and probably at your colleges last year and this year, you're beginning to see some new recommendations on reporting standards, and I'll highlight a couple of those as we go through the statements. So there are 4 primary statements or components of financial reporting that become important in institutional financial management. They are the statements, these are financial reports that kind of constitute the core of representing what our organizations do. A statement of financial position, a statement of activity, a statement of cash flows, and then footnotes and disclosures. So we'll start with the statement of financial position. This is another common phrase for this is the balance sheet. And but the official name is the statement of financial position. And this report summarizes what the organization owns, which are assets, what it owes, which are liabilities, and what the organization has remaining as a corpus to fulfill its mission, or net assets. And in turn, net assets are classified by their degree of legal availability to be deployed to support the institution's mission. And under the current new standards, we have 2 buckets, without restriction and with donor restriction. Prior to this, we would have 3, and I'll highlight that. But the balance sheet or the statement of position is of a point in time. It's as of a date certain. And so it just represents what balances were at the conclusion of your fiscal year. Moving into the next, we've got a visual representation. I've adapted these slides from some work that we did at Northwestern in the last 3 years, because after about a 35-year run of a balanced budget, we stubbed our toe at Northwestern and we not only kind of had to take some extra draws from our endowment to fund some capital programs that we had started, but we needed to also increase communication across the campus about why this had happened. And so we worked on some materials to kind of help people understand exactly kind of the background about how you report kind of what your financial status is. So in the statement of position, if you look to the right, we've kind of adapted it to your kind of home environment, which I think makes it kind of easily accessible. You've got essentially a checking account, which is your cash. You've got resources that are owed to you tomorrow. In other words, your students owe you tuition, your donors may owe you pledges. You may have other types of loans that you've done as an institution, so those are assets to you. You have investments, long-term investments, and that would be the equivalent of your savings account and your 401k or your TIA-CREF retirement account. Land, buildings, and equipment, that's your homes and your cars and your assets, your physical facilities that you own. Your liabilities are anything that you owe, we owe as an institution to other people, we owe them tomorrow. So you have current liabilities. I've got to pay for purchase orders. I've got to pay for, I've got to advance money that I have from the federal government. I have to advance that to students in terms of student loans. So, but typically it's accounts payable. What do I owe vendors? And then you have the mortgage, which is if I've borrowed money in the past for other activities and improvements that I've made, I need to pay, I need to pay for them. And then what's left are my net assets, and that's what your core of your financial strength is. And under the prior standards, there were 3 categories: unrestricted, temporarily restricted, and permanently restricted. The standard setters have decided after 25 years, people really weren't sure what temporarily restricted meant. So they've collapsed it, as I said earlier, into two categories, with restriction and without restriction. So that's your snapshot that kind of says, you know, what do we own and what do we owe? And then we move to the next statement. And that's called the statement of activities. And unlike the statement of financial position, the statement of activities kind of is a cumulative report that's describing everything that happened during the fiscal year. It summarizes what resources the institution earned or was given, and what resources it spent for the entire year. And you're familiar with these revenue categories: tuition, housing fees, fees from services or gifts for operating purposes. Expenses would include salaries, benefits, supplies, services, operations, and maintenance of plant. The expenses that include the using up of assets, as we talked about earlier, such as depreciation or any other obligations to provide future services, such as pension payments, are also included as expenses. And this statement kind of measures performance through a stated period for the entire period ended June 30th. So in the next page, in a similar way, we've got kind of a representation for kind of when you look at kind of a statement of activities, what are you looking at? Well, again, if you want to we continue the household example just to make it easiest to kind of understand. You have your operating revenues are typically listed at the top, that are from your job of teaching with education. If you had any research activities, you would have that as a separate line. If you're selling or you're involved in any other kinds of sales and services of other activity, those would be also related to the education mission. You would see that there as sales and services, auxiliary or professional fees. You might have in your colleges, you might have an active conference program in the summer, or you might have adjunct programs in other times of year, so that would be included in those categories. If we're blessed with some endowment, we take endowment return every year into the operating budget in order to support operations. That's our investment income. And then we call it birthday and inheritance money, which would be, you get gifts during the year, which are kind of for both operating support and any component of gifts that come in that are to be allocated in that year for any capital support. Household expenses, very simple: running the house and owning the house. It takes people. Probably 80% of our operating expenses are tied up in the people of our faculty and staff who serve our mission. But then you have depreciation and interest that, again, gets accounted for in this statement of activity. Bringing these two things together, the balance sheet and the statement of activity, and in prepping for this session and working with Tom, I know he's a big advocate of how critical the statement of cash flow is. Institutions can survive for a really, really long time if they have cash, but you have to have the ability to kind of, the statement of cash flow is kind of what really kind of determines whether you're really you're generating enough resources through current revenue and other sources in order to kind of help fund operations. But it's also an important statement that helps you kind of track your budget reporting to your financial statement reporting. And the reason for that is a lot of times when we do budgeting in our colleges and universities, we tend to budget on what we call a modified cash basis. In other words, if you get a budget report, you're typically, this is a generalization, but you're typically not going to see all of the commitments that you have in that budget. You're going to see what the budget what we've incurred against the budget plan to date, but a budget doesn't typically kind of incorporate all of the obligations that we might ultimately have in the year. And so, whereas your financial statements are reflecting all of those obligations. So the statement of cash flows disaggregates some of that and puts it into 3 buckets and helps you to identify how you're actually performing. So the next page, we have that the cash becomes the lifeblood of the mission, and you have typically 3 buckets of how you account for cash. Kind of what cash you start with, kind of what cash did I have left in my bank account my bank accounts at the end of the year. And then I adjust all of that for any category of revenue or expense that didn't really have a cash impact in that year. So if I billed tuition, but I didn't collect tuition, I have a receivable, but I don't have any cash yet. So I kind of back that out. Similarly for depreciation, I incur an expense, but I didn't have to fund that expense. I just had to record that. So the statement of cash flow, you kind of back out any of the activity that you have to record that didn't have a cash impact, and you're left with the first line, which is the net result is what do I have left in my checking account. Then there's typically a section in a cash flow called investing activities, and that's where if your investment activity, your treasurer's activity, were buying new assets, you would segregate that kind of activity from your operating activity. And that's the cash derived or used in our savings accounts, because we're trying to build up that core of assets. And the last section would be the cash flows from financing activities. If part of my activity during the year was that I issued debt or I had to borrow from some source, I need to reflect that some of my cash came from a borrowing, and therefore I put that in a separate section. And if you add those all up together, operating plus savings plus borrowed cash, you get your total available cash. And you always want there to be more cash, ideally, in every year than you had from the period before. But at a minimum, you'd want to know that if your cash position changed among those 3 categories, you'd want to understand why. And you'd want to minimize the amount of cash that you actually needed for true operations. You don't want to, you wouldn't want to borrow rather for operating cash. It's appropriate to kind of borrow for long-term assets, but this type of statement and monitoring this statement closely helps you kind of identify where your stressors in your kind of overall financial position are. So some good practices on the next page in cash flow planning. And this is what typically your controller, your budget director, and if you have a treasurer position, this is what they're doing, is they're kind of keeping real cash flow data up to date, up to the current date. They're forecasting, they know when new revenue and expenses are occurring. They compare it with past trends. You'd want to always be looking at a forecast that kind of helps you kind of see ahead 6 to 9 months. If you knew you had special cases or significant events coming, you'd incorporate that, and you'd always be wanting to compare to actual so you knew what was causing differences. And a good example that Tom had from an earlier presentation is this is the type of kind of a visual that you can do. The legend at the bottom is a little bit out of date. I tried to change that to the current year, but this would be a type of statement that or visual that would be useful to have, or something comparable in your financial planning, so that you see how you compare from period to period. You could also incorporate a line as a forecast line and then compare this with actual. But keeping your eye on cash is a fundamental kind of discipline. And as we note here in this next slide, a budget is fine, but cash flow is going to define what we can do. That's another good example. So you take the combination of financial reporting, budget reporting, cash flow reporting, all of these, and these become kind of the inputs to the tools for financial analysis. Financial reporting typically is summarized over multiple periods to produce trend information. We also have there are some common statistical measures that are used to interpret results. You see that there's a lot of comparisons and trends, as well as peer comparisons that we like to kind of compare and use ratio analysis or other kinds of analysis because it helps us kind of adjust for size and differences of institutions. Rating agencies, when we borrow money, all of us have to get kind of our debt is sometimes rated or evaluated so that the investor knows what kind of we're doing. And those also have standard measures. Credit banks are banks. And also financial analysis helps us synthesize information for trustees and directors. And I think that would become an important constituency in our universities. So moving on, some of the common ratios that you might see.
Ingrid?
Yeah?
Hey, Tom here. We just covered some really important stuff. How about if we pause just for a minute and see if we've got any questions from the group?
Great.
I'm always confused about depreciation.
Okay.
I just, it kind of sneaks into conversations and I don't quite get to zero in on it. And Ingrid, if you could link the concept of deferred maintenance and depreciation and what is needed in the budget in order to make that be a positive conversation.
Sure, that's a very common conversation and an important one. So if you were to actually, when you calculate depreciation, a lot of times our colleagues who are on the physical plant and operations side, they use common measures for kind of, from an accounting standpoint of determining what the useful life is of an asset. And that's the core, the determination of kind of what depreciation, what constitutes that measure is the sum total of all of these assessments that say we have 100 buildings, we have roofs, we have heating, ventilating, and cooling, we have infrastructure in those buildings, and we assign useful lives to all those components. So depreciation charge from an accounting standpoint is made up of kind of an analysis like that has a lot of input from your physical plant colleagues about useful life. And it says, if you were able to use that building for 20 years or for 40 years, this is how much you're using up of it every year. And in an ideal world, if you were taking an equivalent amount of cash from your operating budget, you would say, if I had $5 million in depreciation for a year, and if I had $5 million, I could put that aside. I'd actually fund that depreciation each year, and I'd be able to kind of, on a systematic basis, be able to kind of make improvements that would keep that useful life of that asset current. What happens for most of us is that if we get behind, the concept of deferred maintenance is when your phys plant colleagues come back and tell you, you know what, we weren't setting aside $5 million a year, we only were doing $2 million a year, and now I've cumulatively got a gap that for a particular building or a facility or for my student housing or for whatever group of assets that they're looking at, they're saying one of two things. They're saying we either didn't set enough aside on an annual basis to build up a fund to kind of help take care of that normal use, but you also have, in the concept of deferred maintenance, sometimes your physical plant colleagues may come and tell you, we need, the use is changing. And a good example of that is in like the sciences. I may be in a physical building of a science building that has a useful life of 40 years old, but the labs inside of those buildings are really have a useful life of 10 years, or they might have a useful life of 15 years. And in fact, I've got to have more infusion of capital in order to renovate that lab. And that will sometimes be called deferred maintenance, or it may be just called, it'll be called just renovation. But the gap that gets developed is that the $5 million in our example that enables you to kind of, that if you were setting that aside on an annual basis, the fact is that most of us use our buildings in ways that are kind of, that need to be renovated on a faster basis. And so the accounting mechanic, you're tending to kind of want to, there's sometimes an incentive to not, to kind of just keep with the accounting definition of the depreciation and those standard definitions, but you can develop a gap easily if you're not able to kind of connect, if I'm not setting aside enough base money, and then if my use of the building changes, how do I kind of fund the additional usage? And sometimes deferred maintenance can be kind of used in both contexts. And you sometimes have to unpack that with your physical plant colleagues to say, no, what are you telling me about? Are you telling me about roofs and the side of the building and the painting and the kind of the HVAC? Or are you telling me about new uses within those buildings? And sometimes it's a combination of both. And as you're probably all familiar, many of us, what you do is you renovate an entire building and you try to take care of all of that all at one time. But the accounting metric of depreciation is kind of driven from some standard factors about what useful life should be. And most of us struggle to even get to that 5 million allocation in the operating budget. Is that helpful?
And then that affects creditors and lending if we fall behind.
Yeah, because they know that what you've got built up, if you were putting together, you know, you were only putting $1 million in against your $5 million charge, and that gap gets bigger, then they know that your ability to kind of maintain your physical plant has a bigger overhang on it than what you're actually representing on your financial statement. So the common measure of, you know, I mean, that's an example of what at Northwestern, what we ran into. We did on a much bigger scale, we launched a major set of building infusions, or building extensions, about $2 billion worth of investment. And that depreciation hit in the very next period. And we didn't provide in our operating budget for the coverage of that depreciation. And then everybody's surprised. Like, well, no, you just put $2 billion worth of buildings up over 2 years, and I've got to take my accounting charge for that is probably $75 million for that $2 billion. And we didn't carve out space in our operating budget for that. So that, you know, the goal is, well, you're going to try to grow your way into that, generating more revenue. But when it didn't happen, we had to take money from the endowment. So, but the connection, I think, is that when I think in the more operating context that you're working at it in a leadership discussion, probably within our campuses, it becomes kind of the proxy for deferred maintenance, because there could be a gap between kind of what your accounting charge has been and what you've been putting in. That's one form. And then you have this other concept of deferred maintenance, which is you're not really putting in net new capital that enables us to kind of help keep our buildings kind of current in a use that is in fact should be accelerated even more from what the accounting charge should be. I'm trying to think of another good example from another, you know, it'd be like an actuarial table that says, like Ann, you were talking about planned giving. You know, it's like the actuarial table says this planned gift, this donor is, you know, on average is going to live to 80, and then you find out they're living to 100, and you've got a gap there, and you thought you were going to get those resources at a certain time. And that's kind of where the accounting is kind of driven from some standard accounting factors, but your plant colleagues are living in kind of a real world. And the way I've looked at it, particularly for small places like the Wittenbergs and our colleges, is if you could even get to the point where you're funding on an actual basis, if you have cash to cover that expense and be able to put that money back into plant on an annual basis, that's the ideal world, because you're not only keeping up you may not be all spending it across every single asset, but you have available resources to enable you to not get behind.
Thank you.
Do you have any?
Oh, sorry. Next question.
Yeah. Do you have any good tips for having those type of conversations with senior financial leadership to not get so far behind on the deferred maintenance?
You know, boy, that's an everyday, that's an everyday struggle. I think, you know, I don't know whether your physical plant people develop something called there's a lot of indexes that kind of characterize what the status is of your plant and of your technology infrastructure. I think it's just really important in both the capital and operating budget process to kind of, you know, put those discussions earlier in the process and not put them at the end of the process. I think a lot of us tend to, understandably, we got to take care of our faculty and staff first and our academic programs, but it helps to kind of have the discipline to look at the capital side earlier in the planning process so that you know what your bogey is that you need to kind of, you don't want to get caught. You particularly don't want to get caught with assets that might also just become non-functional, right? I mean, you don't want things to deteriorate so badly that you might have a real severe problem. So, I mean, the best tip to me is you gotta early and often have a CFO who's willing to kind of take that issue into the planning process, because those types of discussions can shape your fundraising planning. They can shape your other institutional planning, and also a lot of the the priority trade-offs are kind of reflected through the plant, right? I mean, if we have to support a program, do we have the facilities and at the level that they need to in order to do that well? And so it's very, I mean, I wouldn't say that Northwestern ever did this perfectly. I think and I've seen it, and I've seen it in a lot of other organizations. So I just think it's getting confidence in the data, and then having being able to kind of see the results of when you do make steady investments, that it shows in a more beautiful campus, right? It shows that we were able to kind of help sustain that. And I think putting that front and center in the capital process earlier on kind of helps it from what sometimes happen if you let it slip. Then it's always the accounting entry at the end of the fiscal year that says, oh my gosh, what was that? We didn't really adjust it. But our facilities guys use something called the facilities condition index, and that's a pretty good. There are other similar tools that plant people that develop, and it's a good way to kind of neutralize the discussion of by neutralize, I mean it's not just these are kind of industry standards about building reconditioning and building sustaining. And I think boards can kind of understand that on kind of a consistent, if it's reported consistently, then I think there's confidence in the measure of whether we're making progress or not making progress. So I think trying to develop some kind of standardization around how it's described would be one.
Great, thank you.
Ingrid, here's the good news. We got lots of questions.
Yeah.
Here's the bad news. We're out of time. So we've got the section on ratios here in the slides that folks can look at.
Yep.
And if I'm describing this correctly, all this stuff is derived from the pieces you just described.
Correct. Yep.
So as folks can go ahead.
Yep. Further tools that people can use in a similar way, just talking about depreciation in a similar way here, we could, these are just measures that you can use to kind of help normalize kind of trend data. And important with your boards to kind of, because they tend to come from the private company sector, they tend not to understand fund accounting and with restriction and without restrictions. So introducing some standard ratios kind of help leadership kind of help translate what's happening on a consistent basis.
Ingrid, thank you. Thank you, thank you, thank you.
If there are any other questions that people have, you can email me, or after you get, Tom, after you get through the budget section and you have kind of the planning, budget, finance, if you wanted to come back and do a little step session just for Q&A after people have kind of gone through the three, we could set that up.
Great, Ingrid. And if it's okay, I will send, I'm not sure if I had sent your email out to the fellows, but I will do that with a reminder about questions. And and you all have a great day. Ingrid, if you could stay on just for a second.
Sure will.
And thanks a lot. You all take care and all the best.
Talk to you soon.
Yeah. Thanks, everyone.
Thank you. Thank you.
Bye-bye.
Okay. Ingrid, while you're there, I'm going to go ahead and stop recording.
I'm still on here too, and I just want to say thank you, Ingrid. That was